In the next several videos, we're going to review the material that we've covered since the last exam. We're going to go look at both terms and concepts here, and then we'll also look at Excel problems. Now, we started out with risk and return. There's several types of rate of return. Expected rate of return is the return that you think you're going to get, or can calculate that you're going to get, based upon making an investment and knowing what the cash flows are. So you know the present value, you know the future value, you know when you're going to get them, and you can calculate the expected rate of return of that investment. The required rate of return is the return that you need to make an investment. You're going to give up some money, opportunity costs, and what do you require in exchange for giving that up? The risk-free rate of return we've talked about is the return that you're going to want to get even if there's no risk, which is sort of what the name says. We use as a measure of that the rate of return on U.S. Treasury bills. Now that doesn't mean they have no risk. If you continue to invest only in Treasury bills, you will have, over time, an inflation risk. But the 90-day T-bill, you will probably have very little inflation in that 90 days, and you will have very little or no default risk. The market rate of return is the return that's generated by the whole market. Again, kind of a duh, but it's the whole market. So we need to measure that. We're going to want to measure that either with the S&P 500 or maybe the Wilshire 5000 or some measure. But we can calculate the rate of return that the entire market is giving us. Now, in terms of risk, securities have two types of risk. One is systematic risk. That's the risk that's shared by all firms. So if there is a pandemic, all businesses are affected by that risk. If the country goes into a recession, that's systematic risk. All companies share that risk. Then we have idiosyncratic risk. That's risk that's unique to a particular business. So for example, if there's E. coli found in some lettuce at a Chipotle someplace, that's unique to Chipotle. It doesn't affect the car industry, it doesn't affect Nike or anything else. We know that we can diversify away idiosyncratic risk. If we add enough different types of firms, we can get rid of idiosyncratic risk. We cannot, however, get rid of systematic risk. Beta. Beta is an important concept. It's the relationship of the return of a particular security relative to the market rate of return. So if the market rate of return is 1, a beta greater than 1 means we expect or require a greater rate of return from that security. And if a beta is less than 1, then the rate of return would be less than the market rate of return. We're going to look at that relative to the capital asset pricing model. You need to understand the capital asset pricing model. So the required rate of return is equal to, first, the risk-free rate of return. Everybody wants at least the risk-free rate of return. But how much more? We need more return than just the risk-free rate of return because we are taking on risk. Well, the amount of risk is related to the risk of the market over the risk-free rate of return. So we can take the required rate of return on the market, subtract the risk-free rate of return. That will give us the market premium risk. And then we multiply that times beta. So the beta will tell us that if we have to get more return than the market would because of whatever risk, we multiply that. So the beta will be greater than 1, and that last term then will be added. Or the beta might be less than 1. Something does not get affected as much, has less risk than the market, in which case the beta will be less than 1, and that last term will be smaller. But we then can calculate the required rate of return on the security because we add the risk-free rate plus the risk premium that we want in total for our security. We then went to time value of money. That's the notion that money in the future is not worth the same as it is today. It is a nominal value maybe, but not in real value. So here's terms you need to know. Compounding interest. Anytime you hear the word compounding, it means growing, right? Grows and grows on itself. So interest earns interest in a year, and then the next year earns interest on that interest. Then the following year earns interest on the interest on the interest, and it grows exponentially. You'll need to know how to calculate present value and future values. That means solving also for the number of periods. Might say, how long will it take you to pay off this? You need to be able to calculate the rate. What interest rate do you need if you want to have $1 million in 5 years? That kind of thing. Payment. How much money do I have to save each year to have $1 million? So we'll cover these in the Excel portion of the review. Different flows means we're talking about different cash flows over a period of time. Do we have annual payments, semi-annual payments, just the future value? Do we have regular payments and no future value? We can also look at non-annual periods. So non-annual periods are, for example, bonds. Bonds pay interest twice a year, semi-annually. Mortgage payments are paid 12 times a year. So we can calculate that. Or interest on a CD might be calculated daily. And then you have 365 periods. Simple annuities. When I talk about a simple annuity, it means you get paid a certain amount each period. Think of winning the lottery. You get paid so much each year, $20,000 a year for 20 years. Or Publishers Clearinghouse. You win $5,000 a week for life. Those are simple annuities. Those you want to calculate the present value. Compound annuities are ones that grow, just like compounding interest. But instead of just interest, you're actually putting in more money. So saving $5 a day every day, how high does that grow? Amortized loans are a way to look at the time value of money. You borrow money and you have to pay it back. We'll talk more about that in the next slide. APR is annual percentage rate. The annual percentage rate is used to compare different types of interest rates. Some people calculate interest rates daily, weekly, monthly, annually. And the way to compare them all is to look at the annual percentage rate and use that as the value. Finally, we talked about perpetuities. Perpetuities are simple annuities that go on forever. The example we gave, and we'll come back again, is par value is preferred stock. Let's take a look at amortized loans. Amortized loans are loans that you get and you have to pay back. You pay the interest and the principal. You may have done this in an accounting class. Look at the interest payments and look at how the loan gets amortized over time. The principal payments get bigger while the interest goes down because you're paying off the loan. We can treat these as a simple annuity, and we just solve for payment. If we want to know how much we can afford, for example, on a mortgage, we'd solve for the payment. The present value is the amount of the loan. So in the equation, what we're going to want to do is put the present value, and we probably want to put that in as a negative number. Number of periods, obviously, is the number of periods. But remember, it's not just the number of years of a mortgage. It's going to be the period. So if we pay it every month, then it's 12 periods. Rate will be the mortgage rate. but we're going to divide by 12 because you pay 1/12 of that each month. Lastly, payments. That's what we're going to solve for. That will be your monthly payment. Okay, so we'll calculate one of these in the Excel review.